Welcome to this webinar on compliance. This is for Enterprise Ireland clients, looking at all the things you need to know about the UK compliance environment before you enter the UK market. My name is Ben Aspinall. I work for Ecovis Wingrave Yeats. We're a full-service firm of accountants, auditors, and tax advisors. We also, within the Ecovis network, have M&A firms, corporate finance, and legal firm as well. And we're part of Ecovis International, which is a network of similar firms catering for SMEs, mid-market, and international businesses around the world, all the way up to listed businesses as well. We're in about 95, 96 countries at the moment, offering those services I mentioned before: accounting, audit, tax, legal, and corporate finance. So we've been working with Enterprise Ireland for probably at least a decade, on and off with various clients of theirs, looking at how we can help them enter the UK market, whether that's a little bit of initial advice or perhaps doing some outsourcing work for them or audit or tax advice. We're very happy to have initial calls with anyone who's interested, just to give them a feel for what they might need to think about before entering the market. Whether that's the sort of commercial aspects or the compliance environment, specific VAT and corporate tax advice. And it's no obligations call. Happy to give up an hour of our time to chat to you and see how we might be able to help you. So today's webinar is on compliance. So that's really everything you might need to know before you enter the UK market around what does the environment look like here, what do you need to do around statutory reporting, everything from setting up the entity through to the ongoing compliance on Companies House, the registrar of companies here in the UK, and with HMRC, the tax authority here. So we're going to cover accounts and audit, as well as the corporation tax, VAT, payroll and pensions compliance, and then we'll look at just some other bits and pieces around Companies House filings and anything else you might need to know. But initially, we'll start with the formation. So it's fairly straightforward, and it's not dissimilar in the UK to how it is in Ireland. So first thing to know is what your corporate structure is going to look like. So you're going for a limited company, an LLP, probably based on what we see with other Enterprise Ireland clients. We're looking at limited companies or branches. So very rarely is it an LLP, a partnership, and even less common is a PLC. So once you've decided on the corporate structure and the ownership structure, so is it going to be a subsidiary of the Irish entity, or will it be commonly owned perhaps by the shareholders of the Irish entity? You get onto the formation of the entity. So if you want an off-the-shelf formation, which means the Articles of Association are as prescribed by Companies House, then it's relatively straightforward. You can really set the company up on the day that you want to set it up, so same day setup. What I would caveat that with is just that there is some more rigorous, fairly recently, more rigorous due diligence on anyone registered at Companies House, so directors, shareholders. So just if you're going to be a director of the business, you just need to go through a couple of hoops with a Companies House in terms of just registering yourself and getting your identification checked. So once that's all done, the setup itself is fairly straightforward. If you do need to change anything in your Articles of Association, perhaps to prescribe the way board meetings work or how ownership works, then that would usually be done by, if it's a simple change, it's an accountant. But if it's something a bit more complex, then you probably want a legal team involved. So do give us a shout, and we can introduce you there if needed. If it's an LLP, then you register the LLP with Companies House, but you'll need a partnership agreement, which generally speaking you'd need a lawyer to draft for you. So as I mentioned, timelines wise, if it's a limited company, whether that's a subsidiary of an Irish entity or a commonly owned entity, it's very, very quick. So we normally say, look, allow a few days to a week just to get your documents in order and your identification approved. But if you can do that quickly on the day, then you could probably turn around and within a few hours have a limited company set up. The partnership LLP would take a little bit longer just because you probably want the partnership agreement drafting, and that involves obviously third-party lawyers who are going to take a little bit longer to draft that and have conversations with you to get it right. If you're looking at a branch, so an extension of the Irish entity in the UK, then it can take up to a couple of months to register. 6 weeks is probably the quickest we've seen recently. It can take longer than 2 months, especially if Companies House have questions on the setup. So it's just worth bearing that in mind when you're thinking about entering the UK market. How much time do you need to leave? So if it's urgent, a branch is unlikely to be something that works for you. But certainly don't let the branch versus limited dictate which one you go for in terms of what the timelines that you need it to be set up in. If you need a limited company tomorrow, then or an entity tomorrow, then don't just go for a limited company if it's not the right fit for you. If a branch makes more sense, then it is worth waiting. We have done another webinar on sort of branch versus limited versus LLP, so check that out or give us a call, and we're happy to talk you through the pros and cons of each. But the compliance environment for the branch and the limited are fairly similar, really. But as I say, the setup for the branches is a little bit more cumbersome. So moving on to accounts and audit. So we're going to cover really what every entity needs to do. There are obviously nuances depending on the industry you're in and the size of the business you are as well. So take this with a bit of a pinch of salt, but this is broadly speaking what most Enterprise Ireland clients that we've seen would need to comply with. So all companies would have to, so limited companies, sorry, would have to lodge their accounts at Companies House here within 9 months of the year end. First year, so if it's the first period, it's actually 9 months from the year end or 9 months from the first anniversary of the incorporation date, whichever is the earlier of the two. But thereafter, it's 9 months after the year end, the company's the accounts need to be filed. Some exceptions to that, you may need to file accounts elsewhere if, say, for example, you're FCA registered, when you get 80 working days to submit the accounts from the year end. The LLP is exactly the same as a limited in terms of the time to file accounts. The branch is according to what the requirements are for the parent company. So with a branch, you submit the parent company accounts on record in the UK. You don't have to submit the UK branch accounts to Companies House. And the deadline for that is whatever the deadline is in where the parent company is. Excuse me. So that's broadly speaking what you need to do around the accounts. There are obviously nuances with accounting standards, whether you're using IFRS or UK GAAP. Generally speaking, we see people using UK GAAP when they come over from Ireland. Because it typically mirrors what's being used in Ireland pretty closely. UK GAAP is moving closer and closer to IFRS over time, so the differences are reducing. And then just on framework, so that's not the accounting standard, that's essentially around the size of the business. So if you're a micro business, you would submit reduced disclosure, sort of micro accounts where there's very, very little in them. If you're a small entity that doesn't require an audit or has some sort of exemption from audit, then there are again reduced disclosure requirements. If you require an audit, then it's a bit more all singing, all dancing. There are more notes required, more disclosures required, and obviously you need to factor in the timeline to complete an audit. So around whilst we're talking about the audit, what determines whether a business needs an audit is the size of the global group. So this will often catch businesses out. It's not the size of the UK entity. If the UK entity is part of a group, you take all of the group numbers, and even if there's only £100 of revenue going through the UK entity, there would still be a requirement for an audit if the global group crosses the threshold. So threshold, as it says here, you have to meet 2 of these 3. In order to require an audit. So 15 million revenue, 7.5 million of gross assets on the balance sheet, and 50 employees. So if you meet 2 of them for 2 years in a row, the second year would be the first year of your audit. So you get 1 year grace period effectively. So if you enter the UK market, the group's just below the threshold, you don't need to worry. The following year, it crosses the threshold again, you don't need to worry. The next year, if it's across the threshold again for its second year in a row, that's when you would need an audit. We have an audit team here, happy to sort of talk you through that. And obviously, if there's changes in the group, maybe there's new ownership and that pushes you over the threshold, then it's worth having a conversation just to make sure you don't get caught out by whether or not you are required to have an audit. Audits obviously require some planning and require some consideration, so it's worth discussing this early before you even hit the year end to make sure it's booked in, costed into your budget, all of those things. Corporation tax, so the 9 months, or 9 months and a day, in fact, similar to the accounts which are filed after 9 months, the payment of corporation tax, if there is any due, typically due 9 months, one day after the year end. You get 12 months to submit the tax return itself, so actually an additional 3 months to submit the return, even though you've paid after 9 months and a day. You can only have a maximum of a 12-month period with the tax return. So unlike the accounts where you can shorten your year end and have a 6-month period or lengthen it to 18 months, with the tax return, it's only a 12-month period. So if you have a long first period of 15 months, you're actually submitting two tax returns, one for 12 months and one for 3 months. And typically, you might prorate the figures to spread it across the two returns. If you're over a certain threshold, you'll need to pay quarterly installment payments. So that's quips. The calculation for that is essentially 1.5 million of profit in the group. So again, we're talking about the global group. If you have 1.5 million of profit across the whole group, you divide that 1.5 million by the number of entities in the group. So, for example, if there are 3 entities in the group, 1.5 million divided by 3 is 500,000. If there's 500k of profit in the UK, then you'll need to pay your corporation tax quarterly. So it's not 1.5 million of profit in the UK, it's 1.5 million divided by the number of group entities, and that determines what the UK threshold is. So it could be that actually you've got 10 entities in the group, so the threshold's 150. If you've got 20 entities, obviously it starts to shrink. So if it's a large group in terms of number of entities, even if actually there's not a lot going through the UK and you only make 20k of profit, if there's a sufficient number of entities in the group, then you will be required to make payments quarterly. So obviously, one thing to consider is just around other reliefs. So I won't go into these in great depth, but just to let you know, there are various reliefs for research and development and patent box we have over here. So anything around that, where you're bespoking things for tech for UK market or developing anything from scratch, for example, that may qualify for R&D relief. HMRC are clamping down on this, that making sure that entities don't just claim R&D relief without really any substance. So there was a time where almost everyone was with anything remotely sort of tech was submitting R&D relief claims and getting it approved. They're now really clamping down on that, and you're really having to evidence why it's why the work you've needed to do to prepare it for a UK market, or why what you've produced actually fits the bill as R&D. So we can help with that, and we work with R&D specialists. And then there's also creative industry reliefs for media businesses like film and TV businesses and post-production. And then it's also just worth considering capital allowances too. So there are certain schemes, annual investment allowance, and some certain capital assets that can be fully expensed in year one. And there's the annual investment allowance of for most sort of big ticket capital expenditure of about £1 million a year. And that's the allowance for rather than spreading it over the life, capitalising up to £1 million of it in year one, which obviously has the benefit of reducing your profit in that year, year of purchase, and that reduces the tax payable. There's quite a lot to consider around corporation tax, so it's just worth probably having a conversation if if you've got anything remotely kind of nuanced going through the business, then it is worth having a conversation, because it's a relatively sort of complex area of tax in the UK. Which brings me to VAT, which although on the surface should be a simple one, is definitely the most complex of taxes in the UK. So starting from the beginning, if you have a 90,000 of revenue going through in any 12-month period, you will be required to register for VAT. You can register early, which allows you to claim VAT back on expenses, but that 90k threshold is the mandatory threshold for recovering VAT. There are certain rules around what you can claim pre-registration, so you can go back 6 years on services, sorry, 6 months on services and 4 years with goods. So any purchases before you register, you could still capture them in the VAT return. There are, like I say, lots of nuances around VAT. So if you're doing anything with property, buy to lets, holiday lets, that sort of thing, or just commercial developments, you definitely need to have a conversation around that before you enter the UK market because there's a lot to consider and just in the way you set it up and what you need to document and know before you enter the UK market. We're making tax digital here, so that's MTD. That's just the requirement. It's how you report the VAT essentially. So it's making sure there's a clear audit trail between in the software between the source transaction level data and the final output of the VAT return. VAT returns are quarterly in the UK. I believe they're bi-monthly in Ireland, so it's a little difference. The MTD is nothing really to worry about, but it's just making sure you've got some MTD compliant software here in the UK. Most of the well-known softwares that provide accounting tools are MTD compliant in the UK. If you're maybe using a branch, for example, or you just want to add an account in your local software in Ireland, it's just something to consider because if it's not MTD compliant, you're going to have to export transactions into Excel and then push them into another system to get them to be accepted by HMRC on submission. So there's other things to consider, particularly if you're looking at importing goods into the UK, just around having your EORI number and registering with the Customs Declaration Service. We have postponed VAT accounting too, so that you're not necessarily paying VAT every time you import goods, but delaying that to the VAT return, so that if there is any kind of reverse charge mechanism, it's in and out on the VAT return. There's no cash flow impact of paying VAT on import. And like I say, ongoing compliance wise, it's quarterly returns. Typically speaking, we see a lot of first returns being inspected by HMRC. So it's good to get your ducks in a row from day one. They can inspect any return and they'll often inspect the first one, but also any returns which maybe don't match what they've seen before. So if very consistently you're paying £10,000 of VAT every quarter and then all of a sudden you're recouping £20,000, they might inspect that because it just looks a bit different, a bit out of the ordinary. So that's when they might choose to take a look. Sorry, one thing I didn't cover on the VAT was just the registration process. So actually, the process is fairly straightforward. It can just take a little while. So if you're a limited company or an LLP, you're likely to be registered in around 2 weeks. If HMRC have questions, particularly if that's going to happen, really, if the business has any kind of nuance to it, if it's not a typical service business or if it's doing anything that's remotely complex, then HMRC may have questions which will delay the process a bit. So you want to allow a little bit longer. And that brings us on to, branches. If you've got a branch, it will typically take a little bit longer. If it's an overseas registration, so if the Irish entity just doesn't need a presence in the UK, doesn't have a need for an entity in the UK, but does need a VAT registration because of what they're importing into the UK, then that can take a little bit longer. So that can sometimes take six weeks to 2 months to register. So if you're an Irish business importing to the UK with a requirement to register for VAT, it's worth considering that you need to allow some time to get that registration in place, that UK VAT registration for the Irish entity. Onto payroll and pensions. So we have auto enrolment here in the UK. I think there may be something similar in Ireland, whereby there's a requirement to offer pensions to staff here in the UK. If you have a director-only payroll, you're exempt from that requirement. But if you have any employees on payroll, you must offer a pension to them. Must be auto-enrollment compliant. We are not authorised at Ecovis to provide any kind of pensions advice, but we can introduce you to brokers and whoever you may need to speak to, benefits advisors, as and when the time comes. So the requirement there is that you, on qualifying earnings, which are any earnings between 6,200 and 40, I think, or 270, and 50,270. Those within those bands, you need to pay a minimum of 3% employer, 5% employee. So all employees, so that's pension contribution on top of their salary. So the uh, all the requirement is saying is it's on that threshold. So sorry, that band of earnings. So it's if you pay someone £100,000, it's still the minimum is just on that between 6 and 50 thousand, but you don't have to pay anything over and above. We see lots of businesses pay 3% on everything, but it's really, typically you're mirroring what you're doing in Ireland already, or you're maybe you make a decision just to pay the minimum or whatever is going to attract the best talent in the UK. It's entirely up to you, but worth just factoring that into your budgeting because the minimum requirement is that 3%. So you need to add that on to any budgeting before you enter UK market. And obviously the 5% employee comes out of their salary. They can opt out, so employees can opt out of the scheme, but they are automatically on the scheme and they must opt out. So you give them an option to opt out. There's a 3-month deferral period for enrolling as well, just to allow for any kind of notice periods or probation periods, that sort of thing. So you can not start those pension contributions for 3 months, just in case. To save yourself setting them up for 1 month and then they decide they're going to leave or you need to move them on to save you that hassle. So we can provide off-the-shelf pension schemes, but if you need advice around something a bit more exotic, then we'd recommend speaking to a broker. It's worth just noting that recently the employer's NI national insurance contribution went up, so that's a tax on employers. So that's 15%. So you pay 15% on top of the employee's salary. There is an annual allowance for that of 5,000. So the first 5 of NI that you would otherwise be charged, you're exempt from paying. You just need to make sure that that's applied when running payroll. And that's something that should be automatically done. So if we were running payroll, we would apply that, assuming you were you could avail of that relief. The environment around this compliance around employing people is very similar in the UK to Ireland. So you must have UK compliant contracts. Policies and employee handbooks must all be sort of up to date and in place, health and safety, that sort of thing. And then insurance. So the only insurance you're legally obliged to have is employers' liability insurance, up to 5 million, a minimum of 5 million of cover. We would recommend speaking to an insurance broker in the UK, or if there's an Irish broker you can find who perhaps you're already using, who covers the UK, which that does happen, but actually a lot don't since Brexit. Then speak to those just because they might give you a steer on what kind of insurance would be useful in the UK. So things like cyber insurance, or depending on what the business is doing, you might need inventory insurance or that sort of thing. Key man, that kind of insurance. So just worth looking into that before you enter the market because it can just add to that budgeting process. The CIS is the construction industry scheme. So this is just if you're involved in that construction industry, you're probably familiar with this sort of thing already. So I won't go into depth with it, but it does just require registration, and then for any subcontractors you're using, just deducting the tax due and paying it to HMRC on a monthly basis. And if you are the subcontractor, you also need to register as a subcontractor. IR35 is legislation that deals with contractors. So if you're employing contractors rather than putting people on payroll, you just need to be careful about what they're doing. Are they are they in substance actually an employee? So just do they meet a certain threshold that would be considered, you know, they would be considered an employee by HMRC. And if they meet that threshold, which essentially means, are they making kind of management decisions? Can they sign off on things, contracts, enter into commercial agreements? It's a bit more than that. There's a bit more to it, but they're the kind of headline features of employment. Are they given sort of license to roam? Are they acting under your instruction? How does it work basically? If they fall foul of R35 legislation as a contractor, you could be liable to pay the 15% employers NI on what you're paying them. So it's just worth kind of considering if you're not payrolling people and you're using contractors, are they in substance an employee or are they a true contractor? So just the last few bits on compliance. So Companies House I've mentioned is the registrar of companies in the UK. Once you're registered at Companies House, there are some ongoing annual filings you need to make. So whenever you make a change on Companies House, or whenever you make a change to a director's address, or if you're exiting a director, adding a new director, changing shareholdings, diluting shares, that sort of thing, you need to register that at Companies House in the moment when it happens. But then annually, you'll also submit what's called a confirmation statement, CS here on the screen. And that's just confirming, okay, what are the details? Are there any changes from the last confirmation statement? What are the details of the directors, shareholders, and all that sort of thing? So it might just be no change, submit, or it could be there's been updates since the last year, which you would already have filed individually, but it's just collating that and saying what the changes are. And the PSC is persons of significant control, so you're obliged to maintain a register of the individuals who control the business. So typically, if they've got a significant ownership stake or control as a director, the ability to appoint and remove directors from the board, they might be considered to have significant control over that business. I mentioned the FCA very briefly earlier. There are other industry regulators, but that's just sort of one that we might see for Irish businesses entering the UK into the financial market space. They will obviously have their own compliance environment where there's ongoing reporting and other thresholds to bear in mind to register your business with these regulators. So it's worth just considering what industry you're in. Are there other regulations beyond just Companies House and HMRC that you would need to comply with? And there are additional requirements for very large businesses. We haven't seen many of these for Enterprise Ireland clients, but we deal with a lot that are not Enterprise Ireland clients. So typically what we see for Enterprise Ireland are SMEs and owner-managed businesses coming over, and so they don't fall into this bucket, but there are quite a few requirements on the very large businesses just around things like sustainability reporting, having things like your tax policies published on your website, modern slavery reports, that sort of thing, just all documented and available for the public to access on a website or at Companies House. So just if you do fall into that bucket, then consider those things before you enter the market, so you don't fall foul of the legislation and end up with any penalties or anything as you enter the market. That pretty much concludes it. So here's my details here on screen. Do get in touch, give Ecovis a call, or speak to your Enterprise Ireland account manager and ask them for an introduction. We're very happy to just to have an initial chat. No obligations, no fee, no requirement to engage with us. Just it's interesting for us to see what's going on with businesses like yours coming into the UK. So it's informative for us, and if we can help, we absolutely will. So yeah, please get in touch. Thank you for listening.